life stories of entrepreneurs and their journeys in building and raising funds. So a little bit about me. I've been quietly passionate about building and making a change in the world. If it's building a product or a service that adds value to people. It was really in 2013 I came across the word of entrepreneurship. I was so fascinated in the word and how difficult it was to spell. The word there was a very strong sentiment to me, which I automatically knew whatever I wanted to do, I wanted to be in that space. And before knowing what entrepreneurship was or the term of entrepreneurship, I was I was really experimenting and launching a few concepts, which today I can proudly classify them as hobbies and not real businesses, because I found out early on the problems that I was trying to solve worked really well with one customer, which was I. Um, Fast forward, I joined the venture funding world, where I worked with Oasis 500, one of the largest regional accelerators in the MENA region, with a portfolio of 100 plus companies investing in pre-seed stage startups. A lot of my engagement was from the initial contact with the entrepreneur to the actual screening, the contracting with the shareholder agreement and the negotiations in terms of valuation, and then eventually post acceleration, supporting entrepreneurs in scaling and raising funds. Today, as mentioned, I decided to step out from the accelerator world and join the corporate world, but with a fine balance of entrepreneurship, where I lead on AB Accelerator, which is a corporate accelerator arm that focuses on driving digital transformation. So AB Accelerator is a corporate accelerator that invests in fintech startups from all over the globe, with a main focus of accelerating digital transformation by partnering up with these companies and creating fintegration. We're fintech focused, so we only look at companies that are in the fintech space. We're geo-agnostic, so we'll invest anywhere in the globe. And generally, we come in anywhere between seed to Series A, with a sweet appetite to pre-Series A. So far, we've invested in 5 companies, which represent a global scale as well. These companies range from the US all the way to MENA. 2 notable companies that you may know of in MENA that we've invested in. One is Tabby, which is in the buy now, pay later space. And the second one is Hella Insurance, which is in the insurance space, digitizing the sales of motor insurance and soon to launch new products. So fintech to me was really something that I was quite passionate on from day one. And I learned that passion through building further experiments. The first experiment that I went on building was an equity crowdfunding. And this was sometime around in 2013. At that time, crowdfunding was really in its infancies in the MENA region and was just starting to pick up internationally with concepts like Kickstarter and others. I decided that I wanted to build my own equity crowdfunding website, which really focuses on connecting startups with retail investors that can invest up to just $100. I learned quite quickly in the business that the solution that I was building was way ahead of the market, because the problem that I was trying to solve was not a core problem to the customers at that time. And from figuring out that, as naive as I was, I continued to follow my dream. And it was the moment I decided to stop what I was doing was when I met a friend and who challenged me before venturing into any business, follow a very simple exercise. Ask 5 of your target customers, what are their 3 top pain points? And then ask 5 whys until you find the root of the actual problem. Because this gives you really an indication that before you start building a product or a market, Are you validating that there's an actual problem out there? And I've noticed that a lot of entrepreneurs have been have followed the same mistakes that I've done, where we're building a product first before validating a problem and not knowing if this problem is an actual core problem. To me, what I realized that I wasn't building a painkiller. What I was building is an unimproved vitamin. It was that time I decided to jump on the other side and take a co-pilot seat and support aspiring entrepreneurs in building their businesses. I was lucky enough to join Oasis 500 at that time, where we had invested in 60 plus companies. I was managing a portfolio of 30 plus companies, from all the way from a pre-seed, just setting up the fundamentals of the business, to actually hitting traction and scaling and raising their Series A. And going back to the mistake that I did, I noticed it was a common mistake with a lot of entrepreneurs. And the mistake is that generally a lot of entrepreneurs fall in love with the solution and not the problem. And what happens is we become too emotionally invested in an idea that we forget what is the problem and what we're trying to solve and to whom. See, the reality is things change and we need to embrace this change. And the best of the businesses out there were built on solving problems. And if you think about the problem, a problem is the difference between what a person wants and needs and what they can get today. And by falling in love with the problem, that means you gain commitment in customer empathy. You are considering a broad range of ideas, and you're constantly conducting experiments with customers until you validate that this is the real problem that entrepreneurs are facing. And if you look at in today's world, 99% of the successful startups that actually launch don't end up being the product that they thought out to be. And I'll give you a very straightforward example, which is Twitter. When Twitter started, they were called Edu. Edu was focusing on podcasting. They decided to pivot their strategy when Apple launched their own podcasting and iTunes version. Clearly, Twitter had their initial focus was on how to reach the mass, how to distribute information. And that was the problem that they were trying to solve. And it wasn't the problem of a tweet or a statement. And that gave them the ability to pivot quite early, and today to have a very successful company. YouTube as well started out as an online dating site. Today, it has become a product, it has become a video empire. So I think the learning here is that you have to keep changing the product until you reach the customer satisfactory. And the easiest way to keep changing your product is to focus on the problem as opposed to the solution. Is it wrong to fail in love with the solution? Of course not. As long as you follow a very structured process that allows you to say goodbye to a solution that's not working and allows you to fall in love with the next solution. And by talking to entrepreneurs and working with startups, I realized the reason why we fall in love with the solution first and not the problem is that generally we do not validate our assumptions. And the reality is as well that 50% of the startups fail at the product launch. You've probably heard about all these famous stories about Apple, Google, and Amazon, and how they've all started their business in a garage or in the basement. And I think as entrepreneurs, we've taken these stories to heart and are practicing them in the wrong way. Yes, if you're starting a business, work from a basement, work from a garage, save some costs rather than renting an office, but keep your head in the market. Your goal is to gather as many insight and data as you can regarding the problem that your customer is experiencing. And then the only way you do that is by really talking to the customer. understanding the need in the market, and constantly validating the product development of what you're building and what you're growing. A simple rule that I follow for all products that I would launch or with entrepreneurs that I work with is a 50% rule. Spend 50% of your time building the product and the other 50% getting traction. So if you're an aspiring entrepreneur and you're just starting out, spend 50% of your time validating the concepts that you're wanting to build on. So conduct interviews, gather data, talk to people, talk to at least 3 to 4 of your target customers on a weekly basis until you start to hear a reoccurring aspect of the same problem that you're solving. Then that's when you've validated the problem. Also, if you're a business, if you're a startup with an existing business, validation is an iterative process that you will continue from day of launch to exit. So validate, make your decisions based on data. Look at how your customers are interacting with you. Look at your metrics. If it's your monthly active users, if it's anything that hits on your commissions, transactions, bounce rate, your data and traction should be the cornerstone of what your customers want and how you build your product. And by building these products, this is where the data serves you quite well in building your product. Because what I've seen with a lot of entrepreneurs, and as well something that I've had gone through many times, is that we tend to build too much when half of what we're building, the market doesn't really want. And the reason is that we have this myth is that if you have more features, then you're providing more value to your customers. And the reality is that is non-existence. If you look at the Instagrams, if you look at the TikToks out there, a lot of them launched with one feature, one core product, and not multiple products, and they've been successful. So start by thinking about what your customer wants. Don't build more than what the market wants. And a very strong quote that I quietly believe in was Reid Hoffman, the founder of LinkedIn, said, "If you're not embarrassed by the first version of your product, you've probably launched too late." You don't want to get stuck into this cycle where you're trying to build to perfectionism, or you're spending so much time and effort that leads to technical debt. You want to find that fair balance. And I think a good graph, I found this graph that puts this fair balance into perspective, where you don't want to over-engineer something by building so much of what your product is, where half of it is not needed in the market. But at the same time, you don't want to under-engineer and end up building a product that doesn't really have any value or doesn't provide any value to your customers. You want to find that middle balance, which provides a cost-effective engineering. So my recommendation is make the first version of your product very simple and very minimal. And this is where the whole concept of the MVP comes in, right? The minimal viable product, where done is better than perfect. MVP should focus on delivering the very essence of the product in the idea in its simplest form. MVP is considered MVP until it sells, and it must carry enough value to your users. One thing you need to think about MVP is less about the product and it's more about the process. It's how you incorporate this iterative process of building, measuring, learning until the product actually matures. And the best products out there always start with an MVP and then eventually grow into the vision that you're trying to build. So you don't need to build your vision from day one, because most probably your customer may not want the full vision. So start small and grow from there. And a strategy you should follow is fail fast and invest where needed. So launch a minimal viable product into the market, figure out what's working and what's not, and then invest based on that. Other examples of companies who've started out with minimal viable products and are successful companies today, Airbnb. Airbnb, who started with a very simple platform, half of the product features that they had encompassed in Airbnb were actually third-party integrations that they didn't go out and build. And their offering was a simple air mattress in a living room, free Wi-Fi and breakfast. That gave them enough validation to go out and to build a much larger solution in terms of the vision that they're trying to build. Another example is Amazon. Amazon started as an online catalog for books, eventually scaled to become the store of everything. So again, when you look at MVP, think long term. What's the vision that you're trying to build? But act short term. Build minimal versions of your product in order to reach your full vision. 2, refactoring is part of the plan. It's quite fine for you to go and refactor everything that you've done because it's an iterative process and you want to constantly get this validation. Trust me, what I've seen with a lot of entrepreneurs who have launched first product into the market, where we've found out that half of what we were building is not needed, that has caused a lot of issues. And at a lot of times as a startup, you're very limited with resources and time and cash, where you may not have the ability to go and reconfigure your whole product from scratch. I also see it with large organizations where they would launch a full functional product from day one, which is really a beast in the market. And then right after they've launched in the market, the numbers of change request submission forms that are being submitted to a vendor or internally to change the product are quite high and quite costly. So start with building something very simple. And remember, what you're doing is an experiment. A business is a continuous experiment. You have a hypothesis with an outcome to deliver for. So a rule of thumb, an MVP should not take more than 3 months of development. Now, I know for certain industries this may differ. So if you're in the fintech industry or you're in the health tech industry, there are other components that you need to take in consideration with regards to regulation. So a lot of your back office development may be very different than a video sharing platform. You need to incorporate security, you need to incorporate certain risk measures that could lead more time within 3 months. That's fine. However, if you're building a lending platform, yes, you should really focus on ironing out the regulations or any regulatory or security component within your back office development. But do you need to go out day one and build the full value chain? So if I'm a lending platform that does leads generation, underwriting, contracting, and dispersing, do I need to build the full end-to-end cycle, an automated cycle from day one? More likely not. I may just focus on the lead generation and the underwriting because this is where I believe the biggest pain point is. Once I've validated that and I've acquired customers and customers have now started to use my platform, the next steps that I will take is start building the contracting feature and the dispersing. Going back to my entrepreneurial journey, so I've learned a lot working with pre-seed early stage startups. After that, I decided to join with the corporate world where I joined Arab Bank. And as I mentioned, in Arab Bank, primarily focusing on investing in fintech startups. I'm going to take a pause here. I know we have a couple of questions. I'm going to address the questions. If you have any questions, comments, please share them and then we'll continue. So the first question is, yes, we can provide you with a presentation afterwards. Second question is, how many startups usually apply to AB Accelerator program? And how many from MENA and how many from foreign regions? So to your question, we have around, so last year we had around 300 plus startups that had applied. These startups had applied either through our website or through a referral, or we actually went out and headhunted them. In terms of a ratio of where we've invested or what or how many we've invested or within our portfolio. So obviously, being that we are in MENA, we generally see a lot more deals than what we see in Europe or internationally or in Asia. However, if you look at our portfolio, 3 of our companies that we've invested in are in the US, in Europe, in between Germany and Belgium, and then 2 in MENA. So we have a team that looks at on a global scale. We also have partners like the FinTech Hive and other partners out there where we source deals from them. Great. All right. We'll continue now on to the next part of the presentation. So I walked you through in terms of the early stages of the startup and what happens, and really the mistakes that I've seen and the validations that can be conducted. Actually, I'm going to take that one more question and then we'll jump into the other. So thank you. So do you have some hints for B2B startups? For example, it's not so easy to test hypothesis when your clients are corporates. Agreed. I think it's quite different how you look at your testing and conducting your hypothesis if you're a B2B or a B2C company. Obviously, if you're a B2C company, it's much simpler. If you have a concept today in the B2C company, all you need to do is launch a Facebook page or an Instagram page, call it Startup X, put 1 or 2 posts of your value proposition, pay $10 on a campaign, and you're going to get results of people either following, sharing, commenting, or signing up to, let's say, early access of your early access of your product. So it's quite simple, very straightforward. On the B2B, it's a bit different, right? Because on the B2B, it takes a bit of time for the corporate to build that trust and to build that trust to say, you know what, I'm interested to buying your product. Or at times they would want to see an actual product before actually signing onto it. What I would recommend there on the B2B, focus significantly on the feedback that you're getting throughout your sales process. So try to meet as many corporates as you can. Start with your network. Find people that you know that can put you in contact with decision makers. That can just take a friendly meeting and not a purely sales meeting, where you can just bounce off ideas, validate, ask. So that's where I would really start as the first stage. Talk to your people within your network, get introductions to talk to people within these corporates, these decision makers who are really relevant to your product, and just have that interview with them and get the validation. Is that, are you building an actual problem that solves a need on their end? The second step that I would do is I wouldn't go and build the full product once I've gotten the validation. What I would do is that I'd put a presentation together and I'd put a prototype together, and a clickable prototype. So nothing that requires actual development, zero development, drag and drop, something that you can do on platforms like InVision or on PowerPoint as simple, something that looks a bit fancy, can really fake that this is a real product. And again, you don't have to fake it that this is a real product, but I think you get the point. And then go have that second meeting with that customer and pitch your sales pitch. Some customers may say, you know what, I'd like to get a look and feel and a touch of how the product works. That's where you can provide them with the InVision prototype. They can actually test it, come back with feedback. And then once you've signed a contract, that's where I would go and start your development. And you can agree with the corporate that, hey, we're building a product that's quietly customized to you. So it will take us anywhere between 2 to 3 months to build the product that you want. So we can start the contracting by then, and we'll just give you a honeymoon period for the next 2 to 3 months until we get our product ready. So that's one way you can do validations in corporates. Other validation methods in the B2B space, if you're unable to get that sales meeting, which I know at times is very difficult to get to the decision maker, you may not have any contacts there, go as a mysterious shopper. Talk to employees, figure out what tools are they using, What are their main problems? So it's not talking to the decision maker, but it's actually talking to the end user. So going to my example of the loan management system platform, let's say my end user is the loan officer. So one thing I would do is, as a mystery shopper, I'd go talk to the loan officer and figure out, what type of tools are you using today? How long does it take you to underwrite and capture leads? Um, is this process manual or automated? What are your top three problems? That should give me enough validation to go and start building. And then eventually you want to build that relationship. It's all about networking. And going on the question of the POC, is bank encouraging to POC with startups? Yes, a lot of banks today are conducting proof of concepts with startups. As an example, at our bank, we primarily focus on conducting proof of concept. So not only do we invest in the startup, we actually conduct a proof of concept. And if the proof of concept has been validated, then we move into a commercial agreement. The beauty of this is this gives us the ability to test a product that may not be 100% ready to go into the hands of the customer in the market, and gives us the ability to come in early on and say, what works for us and what doesn't. As well, for the startups, gives them clear product market validation, if this is a product that's needed or not. What are the most significant factors that determines whether you will invest in an early stage fintech startup or not? So to me, every investor has a different investment thesis. To me, the number one thing I look at before investing in any startup: who is the team? Who is the person behind this business? Innovation is not coming up with a great idea. Innovation is all about execution. So I want to invest in the team that's really executing this business. When I look at fintech startups and I look at other types of startups, I'm a bit biased in a sense. I like to invest in fintech startups that have founders with experience in the financial industry. So either they've worked at a bank, an asset manager, or an insurance space, as opposed to someone coming in with no experience or background and jumping into the space. And the reason why generally I would be more inclined to invest in that space is because financial industry is a complicated space. And if you are a startup in the B2B space, it is even more complicated. So we have invested in companies that are in the B2C space where founders have had no experience in building financial products, which is fine. On the B2B space, I have yet to invest or to come into an interest of a company that is in the B2C space where the founding team, this could be the CEO, the head of operations, and so on, has no financial background. And the reason is it's because there's a lot of complications into it, and there's a lot of jargon. And when you're sitting down with a CEO of a bank or someone of head of retail or head of corporate, the only way you're going to sell them a product is by speaking their language. So you need to have a bit of a background in terms of their space and what are their pain points and what are the value that you're going to offer. Also, I mean, my validation to that, in the past 3 years of the startups that we've put in front of our business units for a sales opportunity, 99% of the companies in the B2B space that had got interest from our business units were really founders who had previous experience in fintech, either launching a fintech startup or in the fintech industry. Because again, you have to think about it in this following manner: is that financial institutions are starting to embrace change. They're dinosaurs that are now jumping into the space of innovation and change and so on. So they're not very much inclined to change or to try new concepts. So they get more comfortable when you have a fintech, when you have an entrepreneur who understands their business quite well, can speaks their language, and can really ease the journey of change. So really, to me, that's the number one factor. Other factors really depends on what stage you are in the business. Again, traction to me is very important. So if you're an early stage company, I want to make sure that you actually have some traction. Either you've talked to the customers, you've done some validation, interviews, surveys, anything that shows me that there is a problem market fit. If you're a product in the market, but have not yet hit scale, I want to see early indicators of your traction. So again, on the load management system, one thing I would be looking at, okay, is how many corporates have you signed on? Based on the corporates that you've signed on, how many loans have been processed through your platform? These indications give me quite early on in terms of the usability and the adoption. Less other aspects that I look at but are less important to me is the revenue. Obviously, revenue is important in a sense. However, understanding that early stage startups takes a bit of time to gain revenue, as well as fintech startups and high regulated industry startups do take a bit of time in order to grow their revenues. So thank you for your presentation. I know that you mentioned AB looks at early stage Series A opportunities. My question, would you look into a Series B opportunity to invest in growing a SaaS provider of a certified authorization standards to secure open APIs? So happy to connect with you, Ali, after the session and to get a deeper delve into your startup at the stage. Obviously, we are geo-agnostic, so what seed means in MENA can mean Series A in the US. So I'd love to learn more about what stage you're in, how much are you raising, what valuation, a little bit more about your product, and then we can take the conversation from there. Great. So the second aspect I'd like to talk about, and as well, something that I've noticed that I've made a couple of mistakes in, and I've noticed a lot of startups make a mistake, and it's the fundraising.
Faisal, sorry to interrupt, but I can see someone in the audience that has their hand raised. Do you want to take this question now?
Sure.
Oh, never mind, they put it down. I'm guessing it was by mistake. Anyway, there's also another question in the chat box if you want to take that as well.
All right. On my side, it seems like they've all been answered.
This one is in the chat box and not the Q&A box.
Oh, okay. Let me go back to that. All right. Okay, so we are a certified. Oh, okay. So this is Ali on. So Ali, this is on the solution. All right, great. Yeah. So as I mentioned, Ali, we can take this offline and delve deeper into the business and take the next steps from there. Great. So next, I want to talk about fundraising and just to share a bit of my insights and things that I've learned from entrepreneurs in this space. Is one of the most important things about fundraising is that you need to treat fundraising as a process. You should treat it similar to your sales process. And I think what a lot of entrepreneurs at times underestimate is the time and effort it actually takes to raise funds. And as an entrepreneur and as the CEO of the business, you don't have time. You're very limited in time and resources. And you want to make sure that you're not heavily involved in fundraising, that you forget about building the business, which is the most important thing, right? Fundraising is just the lifeline of keeping your business alive. There are other ways of how you can keep your business alive, if it's through your revenue, if it's through grants and etc. But fundraising is a really important aspect that I've noticed that a lot of entrepreneurs underestimate. So my first suggestion to you is treat this similar as a sales process. Structure it from your pre, during, and post requirements. And we'll talk about it in the following slides. Second thing is, don't raise funds on an empty stomach. What does that mean? If you have a runway of 1 to 2 months, don't go out and raise. You need to start don't start then. Start your fundraising at least 3 to 6 months prior to where you have zero within your balance. Because the reality is, and if you come to an investor like me, I'm interested in your business, and I don't mean to be mean, but if you come to me with 2 to 3 months or a month and runway, and I like your business and I want to invest in you, but I know that you are so vulnerable that you're willing to take any deal that I'm going to put on the table, I'm going to maximize my request. I'm going to request more economical preferentials for me, more control terms, and so on. So in order for you not to be in that situation, make sure that you raise quite early, because it takes a lot of time from your first point of contact with an investor to due diligence to eventually receiving the cash in the bank. And you don't want to eventually get to a last to your the last few days of the business where you're unable to complete this process and you have to end up closing the business. So treat this as a sales process. Try to be as efficient and as effective, because time is of essence. So as mentioned, treat it as your sales funnel. Start by first identifying who are your qualified investors. Find the best introductions and batch these meetings, and then refine your pitch after each meeting until you close a lead. And once you close a lead, that should hopefully lead on the momentum to closing the rest of your fund. Right. So starting out, what is the round that you're raising? Are you raising a pre-seed round? Are you raising a seed round, a Series A and beyond? If you're raising a pre-seed round, and let's say today in the MENA, it's somewhere up to $1 million, below $1 million. You're at a stage where you have a pre-product. The product's still not there. Maybe you have a prototype. The key metric is your team. A lot of the investors who will be more inclined to invest at this stage are your angels, your family and friends, accelerators, maybe a couple of VCs as well, not non-institutional. And more likely, you want to position this as an unpriced round, which that means is don't talk about valuations at that stage. It's too early. Valuations is an ambiguous conversation to have at this early stage of the business. You really don't know how much your business is valued. So go with a convertible note that basically says you're not pricing the round today, but you're going to price it on the next round of equity financing or on the next maturity date. Dilution in terms of how much you're going to give out in terms of equity will probably be anywhere between 15 to 20%. Now, if you can give below 15%, that's great. If you can give below 10%, that's amazing. If you give more than 20%, I caution you, again, think about this is a long-term journey. So you want to make sure that you have enough equity. You have enough equity in the game to go up to your Series A, Series B, and Series D. A rule of thumb, at your Series A round, you want to have at least 30% equity, or a lot of VCs would question to come into this business, because at that time, do you have enough incentivization to keep going? The next is seed round. This could be anywhere, again, up to $2 million. You have a product that has launched, at least in beta. You have early traction. You have a mix of VCs, angel groups. You're either on a convertible or a priced round. Again, I would highly recommend convertible note. And then you're looking at a dilution anywhere between 10 to 25. Again, anything below 10% is amazing. Anything between 10 to 15 is good. Anything between 20 to 25, you're on the borderline. Over 25, I caution you. Series A, you're raising 3 million. At that stage, your product is scaling, you have traction, you have institutional investors who are interested in. A lot of the traction that Series A investors will look at is what's your revenue at? Do you have a $1 million run rate and beyond? Really depends on your business. More likely a price round. At that stage, you're going to probably give out anywhere between 20 to 30% of your company. So if you reverse engineer it, if you're going to give out 20 to 30% of your company at the Series A round, you want to make sure that you end up giving small equity quite early on. But again, why is this important? Because you need to figure out what round you're raising, and based on the round you're raising, that is the investors that you go and approach. You don't go approach Series A investors if you're raising for pre-seed, because again, it's just a waste of time. It's taking out of your time where eventually you will not get a lead, and where you need to cherish this time because you have to also allocate it to building the product. So how do you prep to a VC meeting? Have a pitch deck and an email deck prepared. The best pitches is the one who do not use the pitch decks. These pitches are just more of a conversation and a dialogue, and the pitch deck is just helping you in terms of communicating your ideas to the investor. Have a thesis of why this investor is a fit, because if you don't, neither will the investor who's meeting with you. So know why you're approaching. Is this investor investing in your space, or are they strategic in one way or another? Don't ask NDAs in the outset. Guys, NDAs are really BS. You typically want to have an NDA once you get to a due diligence. Investors like me who are looking at 100 deals, 100 deals a year, if not more, we don't have the time to sign all these NDAs. And we're also going to see very similar concepts. But again, if you don't feel comfortable in sharing a deck with an investor that you haven't communicated with, then share a teaser. Don't share your secret sauce from day one. And I also recommend any entrepreneur on your first outreach, share a teaser before you share a full deck. Know that you're not going to get a check from the first day. So every fund has a unique decision process and an ask. So you have to go through that process. When we talked about pitch decks, so at minimum, your deck should include a problem, solution, team, market size, competition, and traction. Again, this is where we talked about if you're sharing a teaser, you may just share your problem, solution, and team. You don't need to share your traction from day one. Once you've had that conversation with the investor and you feel comfortable that this is an investor you can engage with, that's when you can go forward and share the traction. So again, going back to, as part of your fundraising process, you'll need at least 2 decks. One is an email deck, which we talked about as a teaser deck. And the second is a pitch deck, which is more of a discussion base. Your email deck should be something that the investor can review in less than a minute. And the purpose of this email deck is just to get a meeting. You're not trying to get an investment off this deck. It's just, you're trying to send to the investor enough information to be compelling in order to take a meeting with you. The measurements that you should look there is, how long does it take an investor to review your deck? And the second and most important measurement, did they follow up with a meeting? Pitch deck, I think that's pretty straightforward. The measurements that I would do there is, how many follow-up meetings are you getting? And then 2, have they requested access to your data room? If they have, then it means that they're quite serious to spend more time in looking into your business and learning more. A couple of tips, kitchen sink. So this is a repository of the slides that you want to include in your appendix. So after every presentation that you conduct, write down all the questions that you're being asked, develop slides for them, and throw them in the kitchen sink. I'm sure on your next pitch, an investor may ask you the same question the previous investor did. That way you can pull up the slide and you look so cool that you're prepared and ready for all the questions that they're asking. Invest in design. Again, if you're sending a teaser deck and that's what's going out to the investor is really evaluating everything from your email to the deck that you've sent to the information in it. So if the deck doesn't have, if you haven't invested some time in making sure that your deck looks good and appealing, that doesn't really give a good indication and a good message to the investor of the type of entrepreneur that you are. So you can download a template online for $20. When you're pitching, always lead with your strongest points first. What is the most interesting thing about your business? So if you're building a SpaceX type of business, I'd probably lead my pitch with the technology that you're building. If you're building a business in the buy now, pay later space, and you come from the e-commerce space and you've built a business in the e-commerce space and have sold that business in the e-commerce space, most probably I would start out with the team, similar to the solution and so on. Today, I started out my pitch with my experience of working with entrepreneurs, because that gives me the validation, that gives you the validation that everything that I'm sharing with you is somewhat gathered through insights and entrepreneurs that I've talked to and journeys that I've come across, right? So always start with the most interesting thing about your business. Really echoes quite well. Lastly, tell a story. People love stories. That's the way you hook the attention of the audience. There's a reason why Hollywood is a much larger industry than the VC world, is that people love entertainment. When you are, as part of your fundraising process, it's important that you also qualify your list of investors. And that's something that I've noticed with a lot of entrepreneurs, is that investors conduct due diligence on the entrepreneurs, but the entrepreneurs never conduct the due diligence on the investors. And by conducting your own due diligence on the investor, that should save you a lot of time to filter out who are the relevant investors and who would be interested to invest in your business. So first thing, looking at the stage, does the fund invest in your stage? So that is primary one on your checklist. If they're not, then that's not a fund that you want to be actually talking to. Location, do they invest in your geography? If they have not invested in MENA or have no plan investing in MENA, then there's no urge for you to reach out. Do they invest in your industry or sector? What is their ticket size? How big is the fund? Is this a vintage fund? So is the fund still actively making investments? You want to make sure that you don't fall into the trap where you have a lot of funds that are in their de-investment years, so they're not actively investing. And it's great to have these meetings with them, but again, when you have limited time and you want to create a sales process that is efficient and effective, you wouldn't prioritize time to funds that don't have the capital. You would focus more on the funds that have the capital. And then lastly, what is their activity? Have they invested in competitors like you or not? So it's important that you actually conduct that due diligence in order to qualify them. And the reason is, and a mistake that I've seen a lot, and I've seen a lot of businesses actually close down or unable to raise funds, is you're marrying the wrong investor. Venture funding is like a marriage. The wrong marriage can really lead to an ugly divorce. So focus on conducting your due diligence on investors and focus on securing value less than money. And I have a couple of questions here that you can ask. So where on your next VC meeting, you should ask some of these questions. So we talked about how big is your fund? Where are you in your fund? So again, you want to understand, have they fully deployed or not? Do they lead rounds? Again, if you're raising a $3 million valuation, if you're raising a $3 million round, you need a lead, right? So you want to go and get someone who can actually put 1/3 or more. So if that is not a lead, then it's great. Talk to them, but again, focus more on the leads. Understand what are the typical ticket size. Do they do follow-ons? How many deals have they done in the past 6 months? And 2 important questions that you need to ask in order to factor them in within your runway and within your plan is, who's involved in the process? So do you need a partner? Do you need an investment committee as part of the process to give you the green light for investment? And how's the decision made? So very quickly, again, this talks about how to look at investors. So focus on your lead. Your lead is your tipping point. 95%, if there's questions about the round, they're interested to go into the data room, that's a 95% that they're willing to sign with you. If they have their own views of the world, they're not asking you anything about the business, they don't seem very much interested, more likely they're not going to sign. So focus less here, focus more on the upward trends. And I think this is something I can provide you by email, but when you're requesting for an introduction through an investor, focus on founders that have previously been invested. And don't ask VCs that have passed on you to make an introduction, because more likely it won't be the greatest introduction that you'll ask for. So this is again another checklist that I would go over. I mean, this is a very summarized checklist, but as well, it just helps you to start asking questions before you venture into the funding world. And very importantly, take feedback, and based on the feedback, do switching gears. So translating a VC's decision to pass no can mean either you're too early, there doesn't feel a fit with the team, the VC may not have the capital to deploy today, they have concerns about your subsector or the industry that you're in, or truly they're not willing to make any moves right now. But again, the whole important part of this process is, again, going back to your sales process, where you're constantly testing, iterating, and improving in order to build a efficient and an effective sales process. So that's my presentation for today. I have a couple of minutes, and what I'm going to do is I'm going to take questions that we have here. All right. So how many startups usually apply to AB Accelerator, and how many from MENA and how many from, okay. So I believe we've previously answered the startup. So we get over 300 plus startups. Generally we get startups from MENA. Out of these, oh, sorry, I'm looking at the answer. Apologies. All right. And what criteria do you look for in a foreign fintech startup? What piece of advice would you give them in order to be able to enter the MENA region? For us, because we have a very strict mandate in terms of what we invest in, we look for companies that we could see a strategic alignment with the bank within the presence that we have. Today, our bank, we have over 14 banking licenses across the MENA region. So if we see that there is a value that the fintech offers in any of the markets that we have presence in, and that could add value to our customers, our partners, or internally, that is our number one criteria. Other than that, we look at team traction and product. If you're a startup looking to venture into the MENA region, you're in the right channel. FinTech Hive, great team, great opportunity for you to go through their program and to get an exposure on the MENA region and to learn more through their partners. Fintech niche in the B2C are very popular nowadays. Neobank for Black and Asian in the US, neobanks for immigrants. What are the 3 niches? What are the 3 to 5 niches that you believe would shape the B2 fintech industry in the coming years? Great question. So I think what we're starting to see here in MENA is very theme banking, where, as you mentioned, there are banks, neobanks focusing on immigrants. We're starting to see this in the region where a lot of entrepreneurs are trying to build the banks for the teens. So what I foresee in terms of the neobank space is that you will have neobanks for the unbanked. And the reason is, I mean, if you look at this region, we have a high percentage of unbanked or underbanked population of people who either lack the financial literacy or lack trust in a financial institution. So this is a great opportunity for the fintechs to come in, to venture into that space, and to build products and solutions that can serve their needs. So that is on the banked and unbanked. I think on the teens today, there's a huge opportunity to build product for the teens. And if it's for the younger population who are yet not have entered the age of 18 and ventured into the banking industry. So I think that's another great opportunity. I think payments, lending, we're still at the frontier in the MENA region. Alternative lending is a space that we're quite excited about. And then wealth management, overall, we're seeing the volatility, we're seeing a huge entrance of millennials coming into this space. And you have a lot of wealth in the MENA region that will eventually translate into opportunities like these. Sure. So can you please provide us some clarity on key terms on the convertible notes at pre-seed and seed round? So generally on your convertible notes, there are three most important things that you need to take into consideration, which is the maturity date, the valuation cap, and the discount. The maturity date is very standard, is usually 18 months. The valuation cap is basically a ceiling that you're setting for the investor. So if you eventually raise over the valuation cap that you've put out there, the investor will convert on the value cap. So if you said the value cap was 10 million, but on the next round, you actually raised 50 million, the investor will convert on the 10 million. The discount is a discount in a sense where you're giving the investor incentivization to convert on a discounted price from the next round because they came in quite early. So on a pre-seed round, if you can do a convertible note with no valuation cap and just a discount, that would be amazing. If you're unable to do it because a lot of investors will still request a valuation cap, then that's fine. Try to stay away from interest rates on your convertible notes quite early on. That could play more once you get into a Series A and a Series B round. Yes, we do look at startups in the insurtech. As I mentioned, we've invested in Hella Insurance, which primarily focuses on digitizing the sales of insurance with a focus on motor insurance, and they are venturing into other insurance products. So, yep, we are excited about insurance. All right, so our startup has only 6 months and we've earned a contract with a bank in Brazil, developed a POC, we're creating product. Do you think it's time to apply to another open innovation program from other banks who have more different validations, or stay calm and build the product first and then go after another customer? Great question. So I think you need to validate internally. Do you have the capabilities and the resources to take on other projects? If not, generally what I would say is master the product with your first customer, because the learnings that you're going to get out of there will be quite beneficial to help you scale. And once you build it once, it'll be much easier in terms of scaling going forward. So if you do have the resources, you do have the time and effort, I would go and apply and try to find other customers who would be interested in your product. Maybe not go through a full innovation program in a say where you have to go through courses, learnings, and so on, but primarily focusing on sales. I know from the FinTech Hive program, they primarily focus on really putting you in front of the customer. So I would highly encourage you to actually apply to the FinTech Hive program. And actually, to give FinTech Hive credit, our investment in Hella Insurance came out of the FinTech Hive. We got to meet them as a mentor, as part of the program, and we fell in love and we invested in the business. Perfect. I believe those are all the questions that we have. Great. Well, thank you very much, everyone. I hope this presentation was fruitful, was insightful. If you have any questions or you want to apply, please apply through our website right here, which is abaccelerator.co. If you want to reach out to me, please do. My email is here, faisal@albitar@arabbank.com. What I'll do is I'll refine the presentation and share it with you guys, and looking forward to connect with you.